Turn those machines back on!
You are about to enter the Peter Schiff Show.
Show me the money!
If we lose freedom here, there's no place to escape to. This is the last stand on Earth.
The Peter Schiff Show is on. Call in now. 855-4-SHIFT. That's 855-472-4433.
I don't know when they decided that they wanted to make a virtue out of selfishness.
Your money, your stories, your freedom. The Peter Schiff Show.
Welcome, everybody. It's Peter Schiff here at SchiffRadio.com. We got a good show for you today talking about the jobs numbers, the September jobs numbers, which we did not get released when they normally would be released due to the government shutdown. And if you recall, the day of the radio show, when we had the Jobs Friday that wasn't, what did I say? I said, well, it's the reason that gold, one of the reasons gold is down today is because the jobs number is not being released. I said if the jobs number were released, it would disappoint, it would be negative, and gold prices would be rising. Well, I was correct. We got a much weaker than expected jobs number for September, and the price of gold's up about $18 right now on the day and climbing. Silver price is up about 40 cents. The Dow likes it too, right? The Dow Jones up almost 100, NASDAQ up 18, new, not a record high, but a new, 8-year high or something like that, heading to 4,000. Right, the good news is the economy is weak, so now Wall Street analysts are saying, well, the odds of Fed tapering in October are now reduced. Maybe they'll taper in March. You know, imagine what they would be doing if they realized that the Fed is never going to taper. Never, ever do it. They still don't understand. In fact, why is the consensus always wrong on jobs expectations? They were looking for non-farm payroll of up 180,000 jobs. Instead, we got 148,000. There are many big Wall Street firms that were looking for more than 200,000 jobs created. Now, yes, we did ratchet up the previous months by an extra 20,000. But even if you throw that in, we still disappointed. Meanwhile, the trend is important because you see a big drop-off from August to September. Why? That's because the higher interest rates are now taking a bigger bite out of the housing market, out of the wealth effect, spending higher. So, just talking about tapering started to undo the phony recovery, and so the Fed can't do it. Right? That is the box they're in. They have this QE. The QE inflates asset bubbles, which allows more consumer spending. Now the Fed says, oh, we have a recovery. We can now taper. But the minute they taper, they deflate those bubbles, and the process works in reverse. So now they've got to untaper and do more QE. So they can never do it. But Wall Street still hasn't figured this out. Wall Street still expects the gasoline to put out the fire. And they're still surprised when it doesn't do it. So if you're a typical Wall Street economist, and you think that monetary stimulus is going to create jobs, every month that you don't get the robust job creation that you're anticipating, you simply say, well, I guess it's going to happen next month. And then when it doesn't happen next month, you say, well, I guess it'll happen the month after that. Nobody ever admits that it doesn't work, that it doesn't matter how much more stimulus we get. We're never going to create real jobs and economic growth. So the economy is going to keep on stagnating, or we're going to keep on getting more money printing. Now, this is going to be a problem in the currency markets. That's what's going to do it. The dollar right now is at a 2-year low against the euro. The euro now is approaching 138. The next key stop is 140 on the euro, which when we break 140, we're going to break through a key trend that the euro has been in ever since it hit a top of 160 a few years ago. I think once we break through 140, it could be a quick move up to 150. When we break 150, it could be an even quicker move up to 160. When we break 160, that's it. That's when we might have a free fall in the dollar. British pound also strong today, above 162. Look at the Aussie dollar now back above 97 cents. heading up to, I think, 98 cents very quickly. You're looking at the Swiss franc. Dollar really breaking down against the Swiss franc. Look at a chart on the dollar Swiss franc. We're right now at the lowest we've been since November of 2011 against the Swiss franc. So what, 11? So it's, again, 2-year low in the dollar versus the Swiss franc. But in order for the Swiss franc to have gotten as low as it did, it was massive intervention by the Bank of Switzerland. That's when they pegged the Swiss franc to the euro that caused the Swiss franc to sell off. But you look at a chart, I mean, we're just breaking down now in the dollar Swiss franc. And so this currency crisis is going to come. And this is ultimately what is going to burst this bubble and force the Fed's hand. But let me get into these jobless numbers, into the details again of how lousy this report was of 148,000 jobs being created in September. The jobs, 86,000 of the jobs that were created, of the 148,000, here's where they were. Transportation and warehousing, 23,000. Government jobs, 22,000. Retail, 21,000. And temporary help, temp agencies, 20,000. So that's it. So what are transportation and warehousing? Truck drivers, but also like stock boys, people that put things on the shelves and take things off the shelves. Retail trade, what's that? That's a cashier, a sales clerk, right? Temp help. I mean, these are low-paying jobs, government jobs. A lot of them are teaching jobs. So again, more real low-paying jobs. Good jobs. What do we get? We added 2,000 manufacturing jobs. Big deal. Information, technology jobs, 4,000. IT jobs. Professional and business services, 12,000. That's it. We're not creating any good jobs. We're not creating high-paying jobs. We're creating BS jobs, low-paying temp jobs. Now, for some reason, the unemployment rate ticked down to 7.2. Even though we barely created any jobs, the unemployment rate went down. The labor force participation rate held at the lowest it's been in 30, 40 years at 63.2. And average hourly hours worked were unchanged, and real incomes are up 1/10. Wages up a tiny increase, which really, here's some number that really raises an eyebrow. According to the government, 691,000 full-time jobs were added in September. Well, how could that be if we only got 148,000 jobs? Well, according to the government's household numbers, 594,000 people who were part-time in September lost those jobs and got full-time jobs. So about a 600,000 person turnover. No way. How is that possible? Basically, the government has taken the last year or two of all these part-time jobs replacing full-time jobs, and now they're pretending it didn't happen. There's no way that we created 600,000 full-time jobs last month when average hourly earnings didn't go up at all. Now, if 600,000 people that were working part-time are now working full-time, why wouldn't the work week have gone up? That's a huge number of people who were working 30 hours or 25 hours. They're now working 40 hours, yet the hours worked didn't go up at all. Meanwhile, average hourly earnings basically didn't go up either. So you're telling me that all these full-time jobs don't pay any more money than the part-time jobs? That when people got full-time jobs and lost their part-time jobs, they didn't get a raise? But again, what's even more amazing is somehow they're working full-time instead of part-time, but they're not working any more hours. Look, the numbers are just made up. I bet Obama was getting concerned about all these part-time jobs and being criticized for creating part-time jobs instead of full-time jobs. So he called up his buddies at the BLS and said, do something to fix this. We need to show a lot of full-time jobs. And so they played around with the numbers, and they came out with this bogus report on 600,000 full-time jobs magically being created into existence without any evidence that they're actually there. 855-4-SHIFT, that's the number. We're going to continue to talk about these jobs numbers and the market reaction and take your calls after this.
Peter Schiff Show. Historians agree if Thomas Jefferson and Thomas Paine were alive today, both would be Schiff Radio Premium members.
Somewhere up there, Thomas Jefferson is looking down with great pride.
Schiff Radio continues right now.
Later on this afternoon, for those of you who are in the New York City area, I'm going to be attending a fundraiser for Congressman Paul Braun, who is running for the United States Senate in Georgia. He's in a Republican primary. He's, I think, the best candidate out there. Ron Paul's endorsed him. I endorsed him. I've donated to his campaign. I have recommended other people support him as well. Well, there's a fundraiser. I'm going to be at it in the city today. It's going to be held at the National Republicans Women's Club. The solarium on the 9th floor is 3 West 51st Street in Manhattan. 3 West 51st Street. It starts at 6 o'clock. I'll be there 6 to 7:30 to support the congressman. It is a fundraiser. The basic cost to attend is $500 minimum, and then you have higher levels. But we've arranged for listeners of this show, if you want to show up, you can just make a $150 contribution at the door and attend the fundraiser. So it's a good way to give a contribution to the congressman. Hopefully he can win this primary. Georgia is going to send a Republican to the U.S. Senate. I mean, there's just no way they're not going to do it. So the real race is in the primary. We got to make sure a real libertarian free market guy wins that primary so he can be seated in the U.S. Senate to help out people like Senator Rand Paul. So again, I'll be there this evening for Congressman Paul Braun. Show up, and again, it's only $150, 3 West 51st Street. Hey, also for the Canadian listeners out there, I'm going to be in the Toronto Monday show, at the Toronto Money Show, excuse me, on Thursday and Friday. I give a keynote address on Thursday at 11:30 a.m. to noon, and then I do a workshop on Friday, October 25th, from 12:15 to 12:45. So if you're in the Toronto area, make sure and visit, the Money Show. It's free. You just got to sign up. You don't have to pay anything to go. And I'll be there with some of the guys from Euro Pacific Canada who work at the Toronto office, so a good chance to say hello to me and to meet some of the guys that are working up at Euro Pacific Canada, Toronto. Let's get back to what's going on in the markets, because now, look, the Dow now up 120 points. Market going up, right? Why? Bad news is good news. Bad news means the Fed is going to keep printing money. Although, again, when you read the language, they're talking about raises the probability that they won't taper. The probability that they won't taper is 100%. They're not going to taper. They kept saying, but Wall Street still doesn't know this. Wall Street still thinks that it's possible to taper. They still are clinging to the illusion that quantitative easing are the training wheels on the bike and not the only wheels on the bike. They think it's possible for the Fed to create a recovery based on QE and then remove the QE and the recovery is still there. It can't happen. Remember, the economy that lives by QE dies by QE. That's what I said. You have to keep the QE in order to keep the recovery. But the recovery's phony. And the idea that the QE can be stopped and the economy can keep on growing is absurd. What Ben Bernanke doesn't want to admit is that if he ever tapers, if he ever tries to stop QE, we're going right back into recession, which would be an admission that the QE didn't work. Because if the QE only works until it's withdrawn, then it doesn't work. If it's just a temporary high, like a drug that wears off when you stop taking it, it doesn't work. And the bigger problem is when the QE drug wears off, it's going to reveal an economy that is in even worse economic shape than it was before the QE drugs were administered. So all the QE did was cover up the symptoms so that the disease could get worse. But we didn't know it was getting worse because we were high on the drug. That's what they don't want to admit. So they have to continue. But for some reason, Wall Wall Street can't figure it out. Now, one of the reasons is they don't want to know, right? Why don't they want to admit the truth? Because they can't handle it. They'd rather live in the lie because the truth is so, shocking to them that in order to really help the U.S. economy, we've got to discontinue the QE that is propping up all these banks and all these brokerage firms. We can't fix the economy until we break Wall Street, until we break the banks. And so they don't want to acknowledge that very unpleasant reality. So they'd rather live in a fantasy, right? Just again, I use the Matrix analogy, but they don't want to admit that they're a battery. They don't want to admit that they're just squished up in a vat with a bunch of tubes coming out of their body. They don't want to admit that that's where they are. They want to admit they want to pretend they're living in the reality of the Matrix because it's a lot better than where they actually are. So they don't want to acknowledge it. So Wall Street, they don't want to admit the reality that they're living in. So they want to live in this fantasy because the fantasy is a lot more pleasant than having to deal with the reality. Because the reality of the U.S. economy is a disaster. And again, well, here we are. How many years are we after the supposed end of the recession? How many years into this supposed recovery are we? Yet look at the quality of the jobs numbers that we get. And we're getting ready. I said this yesterday's show. We're getting ready to go back into recession. Yet look where we are. Look how pathetic the recovery was with record amounts of monetary stimulus. That's all we got. And now we're going for the next recession. And as I said many times, if you thought the Obama recovery was bad, when do you see the Obama recession? Ben, on the line from White Plains, New York. Ben, you're up.
Yes. Hello?
Yeah, Ben, go ahead.
Yes, Peter?
Yes.
I got through. I wasn't expecting to get it that quickly. I want to make a comment, which is exactly what you're saying about that full-time job. The reason why there's so many more full-time jobs because the new full-time job definition is 30 hours. Don't forget it, according to new Obamacare law. That's why, because when I'm retired now, but when I used to work, a full-time job was, I think, 40 hours, maybe a little bit less. I'm not sure what the number were. But now it's only 30 hours. That's, of course, there's so many full-time jobs.
I don't know. I want to check that. I still think for employment purposes, full-time would be 40 hours. But for Obamacare, the threshold is 30. But,
well,
I would find
that's how they determine it now. That's what they do now. It's always
but I'm not sure. Yeah, I'm going to check that out. Maybe I can have my staff check it out during the break. For the purposes of the jobs numbers, when they're categorizing somebody as full-time versus part-time, if they're working 30 hours a week, is that considered a full-time job or is that considered a part-time job? That's a good point. And has it always been that way? Or do they lower it? But I know for Obamacare, if you're under 30 hours, your employer doesn't have to provide coverage, which is why, most people are going to see a lot of, lower skilled jobs are going to go from 40 hours down to 29 and a half to get under that criteria. But thanks for the call. Next up, Thomas Anderson is my guest. We're going to talk about the upside of debt, his new book regarding why you need debt. So we'll be right back. We got a quick break and then my guest after this.
We now return to the Peter Schiff Show. Call in now. 855-4-SCHIFF. That's 855-472-4433. The Peter Schiff Show.
Joining our program now is Tom Anderson, and Tom is the author of a new book, The Value of Debt, How to Manage Both Sides of a Balance Sheet to Maximize Wealth. And Tom's been working in the investment banking industry in New York for quite some time, and now he's working in private wealth management, and I believe his book is a tool to help individuals manage their wealth and manage both sides of their balance sheets, the assets and the liabilities. Tom, welcome to the show.
Hey, thanks so much, Peter. How are you doing?
I'm good. So debt, debt is something that we certainly have in abundance in the United States. In fact, we recently ran up against the debt ceiling, and the reason we wanted to raise it is because we felt we just didn't have quite enough debt yet. We needed some more debt, and therefore we needed to raise that ceiling so we can, as a society, take on even more debt. So there are a lot of people that think debt's a great thing, and that we need more of it. But I'm going to get your thoughts on debt. And first of all, I look at it two ways, right? I differentiate, and let me know if you do the same thing, between consumer debt, where you borrow money to spend, which is what the government does when it borrows money to make payments to Social Security recipients or welfare recipients or unemployed people. That's borrowing to spend. Or what individuals do if they borrow money to buy a car or to take a vacation or to remodel their kitchen, right? They're borrowing money and they're spending it, versus a business decision to borrow money to make a capital investment, to buy an asset that will generate income that will service the debt and ultimately liquidate the debt as the income. So I think borrowing to produce and borrowing to make capital investments is a wise use of credit and is good, but I think borrowing to consume or spend is very destructive to the economy.
Peter, I really respect your views, and you said it perfectly. I mean, that's exactly the way that you should be approaching it, is that you have to differentiate. This book is not about buying things that you cannot afford. It's not about, as you say, borrowing to spend. It's about making strategic decisions and saying, look, I can pay for this, but instead I'm going to invest the money and buy, as you said, productive assets. I think that's a perfect way of framing it.
So, but from an individual basis, though, most individuals, when they're borrowing, they're not buying a productive asset. I mean, it's possible if you need a car to get to work and you take out a car loan, you can say, well, if I didn't have this car, I couldn't get to my job, and therefore I couldn't earn this money. But you might say that's okay if I'm borrowing to buy a Hyundai, but if you take out a car loan to buy a Mercedes, clearly, that's consumption. You're not investing in that Mercedes.
There's no question about it. And what I do is I start out by laying the premise that, look, there's good debt and bad debt, and so you have to be approaching it that way. If you think about it, if I have a credit card debt at 18%, and I step in and I pay that off, well, I get a guaranteed rate of return equal to 18%. I mean, you can't do that in anything else. So of course you want to step in and pay that down. If you have consumer debt that's out there at 8%, then maybe you want to rush in and pay that down as well. But what I lay out in the book is it is possible that some structural debt might be a good decision and that you could over-prioritize then investing in liquidity and what might be good structural debt. Let's say you have mortgage debt at 2, 3, 4, or 5% that maybe based on your tax bracket is fully tax deductible, and it might be coming off right off the top and not even subject to AMT. So your after-tax cost of that debt is even lower. And as you and I know, so many people do not have liquidity. And in times of crisis, such as 2008, if I had over-prioritized paying down my mortgage, but I didn't have money in the bank to be able to ride out a storm, then that's when you get into real trouble. And I, like you, am very concerned about the debt level of the United States. I think that there's a possibility that we could go through some very turbulent and tumultuous times ahead of us, and that what you need is liquidity to be able to ride out those storms.
Yeah, although your point, though, about the mortgage debt, and the reason, and unfortunately the reason, and I recommend now that people have mortgage debt too, I agree with you. I mean, I have mortgage debt. I can pay off my mortgage. I can write a check and it'll pay off my mortgage, but I don't do that because I've got 30-year debt at 4%, and I just assume pay that debt off 30 years from now, rather 30-year debt at 4%, when I think the money will have no value. I think that why it makes sense to be a debtor right now is because the creditors are getting taken to the cleaners by the Federal Reserve. The Federal Reserve is basically waging a war on savers and confiscating, plundering the wealth of the saver and giving it to the debtor. And the debtor being the U.S. government or American citizens that have a lot of debt. So you want to borrow money today to accumulate an asset, right? Even a non-income producing asset like a house, because the house is real. But the money that you borrow is phony, the money that you borrow to buy it. And if inflation wipes out the value of the dollar, then you end up with a real asset that you basically got for practically nothing, because the person who loaned you the money to buy that asset isn't going to get paid back the money they loaned you because inflation is going to destroy its value.
To your exact point, I mean, if you think about it, we have a clear debt problem within this country. I think that much is clear. I think it's also clear that economic history is very cruel to countries that have a high debt level. The problem is you don't know what type of a future you're going to have. Do you look more like Japan? Do you look like Argentina? Do you look like Greece? Do you look like France in the 20s or England in the 50s? But in any circumstances, although those are very different economic environments, you don't really want to look like any of them, right? I mean, so when you have a lot of debt, the country either has to default, which hopefully you cross off the table, but obviously they wanted to even play with that last week. I mean, but that's crazy, right? The implications of it. Or you have to have growth, or you have to have inflation, or you have to have devaluation. So if you are borrowing, what you're actually doing is reflecting a view to your exact point on that economy. But the key is that you cannot afford to be borrowing and consuming money right now. You got to be borrowing and deploying that money into productive assets. What you expressed, I spot on agree with.
Yeah, and I agree that if you borrow, if you borrow and you buy real assets, let's say if someone borrows and they buy income-producing foreign stocks, which I think is great for people to borrow, because if I can borrow money in dollars and then invest in let's say a New Zealand property trust that's got a 7% yield in New Zealand dollars, and right now the New Zealand dollar is worth 85 cents. And if I think in a few years the New Zealand dollar is going to be worth $2 or $3, and I can buy that New Zealand dollar yielding asset now, and if I can borrow at 3 or 4%, and I immediately get 7% income on my asset, which more than pays the debt, eventually, I own that asset for free, and then I can start consuming. Then I can take my appreciated New Zealand dollars, and then I can go and buy all the consumer goods I want. I think it's a mistake to overbuy consumer goods today. I would rather invest in real assets, let the dollar collapse, and even though prices will go up for my American friends who only have dollars, prices will plunge for people who have foreign currencies or people that have gold and silver. They're going to be able to go on a shopping spree because they'll be able to buy what all the Americans are now too poor to afford.
So I've done quite a bit of research on your exact point, and I know that you have as well, as have many other people throughout academics. And what's interesting to your exact point is that people exhibit this extreme home bias within how they invest their money. If you look at, many Japanese investors today invest over 90% of their money in Japan. If you think about that, you just think, wow, would you want to have 90% of your money in the yen where their debt levels are higher than ours? And you think about that, the risks that are inherent in that. Or you can go back over time and say, look at each one of those events, the amount of money that Greek people concentrated in Greek stock and bonds, or Argentinians concentrated in Argentinian stock and bonds. If you take a world-neutral approach to asset allocation and have a globally diversified income stream, it can be rewarding. Now, of course, there are risks to it, but look, to your point, if you were a Japanese investor, there are two ways you could be up approximately 20% this year, right? You could have taken your money and owned Japanese equities. But even if you had your money in treasuries, right, where the yen has depreciated dramatically versus our currency, versus the yen, then they're also up in that 15 to 20% range. I mean, if I'm in a foreign bond paying me 3% and the dollar falls by just 3%, I'm up 6% and I did it in bonds. And I'm not making any, right? So,
yeah. But the thing is, too, that I think that the urgency for Americans to invest abroad is far greater than the urgency for the Japanese, because you talk about all the debt that Japan has. If you net out the over $1 trillion in U.S. Treasuries that the Japanese government owns, if you net that out, that takes the debt down dramatically, because we owe the Japanese because the Japanese people have borrowed a lot of money to buy our bonds. So a lot of the money the Japanese government has borrowed has simply been lent to the U.S. government. So when you net that out, the Japanese debt comes down rather substantially. Plus, when you look at the Japanese citizens, right, the Japanese citizens have enormous net savings, so they can theoretically afford to pay their share of the government debt. But in America, it's very different. The U.S. Treasury doesn't own any foreign government bonds, so nobody owes us anything. We just have trillions of debt. Meanwhile, American citizens are also in debt. So unlike the Japanese citizens who have a lot of savings, American citizens have their own debt on top of their share of the government debt. So there is no possibility of ever repaying anything. That is the big fiction of our gigantic global Ponzi scheme. We have borrowed so much money that repayment is impossible. And all we can do is postpone that admission by going deeper into debt. So what we have to do is keep borrowing money because we can't pay back any of the money we've already borrowed. We have to keep borrowing more and more and more and going deeper and deeper into debt until our creditors realize the game that we're playing. And they don't want to play it anymore because they don't want to throw more good money after bad. Because any money you've already loaned the United States government has already been lost. And if you want to keep lending us more money so you don't have to acknowledge that mistake, so you don't have to write down your asset, all that means is when you eventually do the right thing, you have to take an even bigger loss because of all the good money you threw after bad during the time period that you were living in a debt denial. But hey, we got a commercial break. We'll come back. We'll talk a little bit more about debt and maybe how to use it to your advantage after this break.
The Peter Schiff Show.
You've heard of Karl Marx, right? Well, no. Meet his worst nightmare. This is the Peter Schiff Show.
Tom Anderson, the author of The Value of Debt, how to manage both sides of the balance sheet. And, you know, Tom, the problem with most Americans is the debt side of the balance sheet, right, is overloaded. Most Americans, you know, if you net out their assets and their liabilities, they're broke. But for wealthier Americans that have more assets and the ability to take on more debt, they're able to structure their personal balance sheet in a way that has been beneficial. I think that's one of the reasons that you get this continued disparity in wealth between the upper end and the lower end. And a lot of it has to do with the ability to take on debt to accumulate assets. And unfortunately, lower income people are spending all their money surviving. And when they're borrowing money, they're doing it to consume. And so their wealth keeps getting smaller.
So it's a real problem. So to kind of frame how this came together, you know, I started out with this academic background with, Washington University and University of Chicago and some programs I did at Wharton and so forth. And then when I worked in banking, my whole life was kind of geared toward companies. And I realized that companies have a very clear strategic debt philosophy, right? They don't choose. If I don't take on enough debt, and you see this in the news all the time, right? Like Carl Icahn is mad at Apple for their capital structure, saying they should issue more debt, buy back shares, right? And so CFO is saying, I need to take on more debt. And less than 5 companies in the United States are AAA as a result of this. Companies choose to embrace debt. But they also choose to not have too much debt because there's a risk that if they take on too much, they could go bankrupt. So they take this kind of happy middle ground. And when I moved from the corporate finance world to the individual side, I realized that there's this huge disconnect between the ways that companies think and the ways that individuals think. I mean, people, to your exact point, tend to either be way too highly levered and don't have any type of a debt strategy, or their debt strategy is, I'm going to rush in and pay off all of my debt as fast as I can. And as a result, my research shows that people are either way too high in debt or way too low in debt. Very few people are within what I would call an optimal middle range, a strategic zone. And if they happen to be there, they got there by luck rather than a strategic choice.
But you know, the problem is, though, from a macroeconomic standpoint, is because the Fed has interest rates so low, they're skewing those decision-making, that optimal level, because the corporation that is being pressured by the shareholders to take on debt is because they can borrow money really cheap from the Fed and use that money to buy back their shares. So if the stock has a dividend yield, let's say, of 3%, and you can borrow money at 1%, then for every share you buy back, you increase the earnings per share or the dividends available for the shares outstanding, because you're canceling something that you were paying 3% on, and now you're only paying 1%. But if the Fed let interest rates go to where they need to be, maybe 7 or 8%, the pressure on corporate sharebacks would be gone, because it would be impossible for corporations to borrow money and to buy back stock in an accretive way, because the interest costs would be more than what they were saving by not paying dividends on the shares that they bought back, or just from a PE multiple perspective, not having to spread the earnings over a larger share base. But what would happen if interest rates did go up to 7 or 8% is money would still be borrowed, except it would be borrowed by businesses looking to buy equipment, make capital investments that would actually grow the economy, produce more goods and services, and provide jobs. Instead, all of the money goes to speculators on Wall Street, or it goes to households that want to lever up their balance sheet to get ahead of the inflation curve. They want to borrow money to buy a house, but none of that improves the economy. All of that is helping to undermine the economy.
Well, there's no question in my mind that this is an artificial environment. I mean, if you think about the past 12 months, if the Federal Reserve is stimulating at $85 billion a month, and you're running, we could argue if it's a $500 billion or trillion dollar deficit, or roughly the $700 billion deficit, that's a tremendous amount of stimulus where you're pulling forward that future consumption into this environment. And so, how do you make good decisions within that? And I think that, number one, if you are borrowing money, you want to make sure that you're taking that and buying assets, you're not consuming it. And then number two, you want to make sure that you're ideally buying what are considered to be inexpensive assets, which of course we never know at any given point in time, but you want to avoid borrowing to buy overpriced assets, or then you come into an even tougher situation. What I find is a lot of people who do choose to borrow money are borrowing it to buy potentially, if they do invest it, the wrong assets, right? That they need to be thinking about diversifying their portfolio from a wide range of shocks that we could face. And to your other point about interest rates being at 6%, I don't think that they will, I don't think they can be at 6, actually. I think they either stay low or they go to numbers higher than 6 for sure. I don't think that 6 will be a stable equilibrium either.
Well, I think interest rates are going to go much, much higher as well. But on the way to 10 or 15 or 20, they're going to pass through 6. But yeah,
right, mathematically.
but yeah, interest rates are going to go very high, I believe. But I think that the Fed is going to have to resist that with everything that it's got. So that means that in order to keep interest rates from exploding, the Fed is going to explode the money supply. The Fed is going to be doing QE on a much bigger scale, not just $85 billion a month, not just $100 billion a month, maybe $150 billion a month, $200 billion a month. Who knows where it's going to stop? But the Fed is going to keep on ratcheting it up, I think, until the dollar really just comes into a free fall. And then it's not going to matter, because then the currency crisis is going to be a bigger crisis than just rising rates. And the currency crisis is going to usher in a sovereign debt crisis. Whether it doesn't matter. It's not going to matter how much money the Fed prints. So you're right. What people need to do is they need to understand what's going to happen to the value of savings, what's going to happen to the value of the dollar. And to save themselves, they need to lever up in the right way. They need to buy assets around the world, preferably not in the U.S. Get assets outside the United States, even if you have to borrow the money to do it, especially if you can buy income-generating assets. The key is understand the risks of all this. We talk to some of the brokers at Europe Pacific Capital about the dividend-paying foreign assets, and you're right. You don't want to borrow and overpay. We like to buy stocks trading with single-digit multiples so that we're not overpaying for our assets, and we want to get a good dividend yield, a dividend yield that's higher than the cost of borrowing the money, so we have our own positive carry while we're waiting for the bottom to drop out of the dollar, which I think we're not going to have to wait too much longer looking at the action in the currency markets today. But hey, Tom, thanks for coming on the show. Hour 2 of the Peter Schiff Show is up next. We're going to talk about what's going on in the market today, currency, stock market, and reactions to the jobs numbers after this.
Make no friends in the pits and you take no prisoners. 1 minute you're up $500,000 in soybeans, and the next, boom, your kids don't go to college and they repossess your bank. Are you with me?
The revolution starts now.
We have to pass the bill so that you can find out what is in it.
Turn your machine back on!
You are about to enter the Peter Schiff Show.
Show me the money!
If we lose freedom here, there's no place to escape to. This is the last stand on Earth.
The Peter Schiff Show is on. Call in now. 855-4-SHIFT. That's 855-472-4433.
I don't know when they decided that they wanted to make a virtue out of selfishness.
Your money, your stories, your freedom. The Peter Schiff Show.
Hour 2 of the Peter Schiff Show is underway. 855-4-SHIFT. That is our phone number. The market, the Dow Jones, has lost almost half its gains. The Nasdaq Composite has actually turned negative a bit, but not so for gold. Gold is now almost double its earlier gains. Gold now up $27 and rising. Now, so much for Goldman Sachs's. Gold is a slam dunk sell as soon as we raise the debt ceiling. What, a more clueless statement was ever made by an analyst, which is why I questioned at the time that Goldman Sachs was just being disingenuous, and that's a nice way of saying lying, because they actually wanted to buy gold and they were trying to convince others to sell it to them. Now, maybe they weren't just being deceptive, maybe they were being dumb. I don't know, we have to find out. But anybody who followed Goldman Sachs' advice, anybody who took that advice seriously and sold their gold really regrets it. Anybody who shorted their gold is feeling the pain even more as the price of gold continues to rise. In fact, even Dennis Gartman, again, when gold was on the absolute low, Dennis Gartman came out and said, it looks horrible, sell. And he said that if gold can't rally now, with the debt ceiling crisis, I don't know what could make it rally. That's how bad it looked, according to Dennis Gartman. Now, what I knew at the time, and Dennis obviously didn't know, that what could make it rally was raising the debt ceiling. And Dennis Gartman said, but there's a crisis that we might not raise the debt ceiling. Yes, that's why gold was going down, because some people were dumb enough to believe that we wouldn't raise the debt ceiling, that we would actually deal with the debt. I was so confident that we would not do that. That's why I knew the price of gold would go up. So people were fearing that the price of gold might go down if we didn't raise the debt ceiling. So they were afraid to buy it. They had it so backwards. You couldn't have been more backwards. So I knew that they would raise the debt ceiling. That's why I knew the price of gold would go up. And they did raise the debt ceiling, and that cleared the way for more debt, more inflation, more government. That's exactly what the gold investor wants, right? Or that's what you're expecting when you buy gold. The reason you're buying gold is because you do not believe the government will act in a fiscally responsible manner. Not raising the debt ceiling, that would have been fiscally responsible. But now they've redefined fiscal responsibility. It's now fiscally irresponsible to oppose more debt. The responsible thing now is more debt, right? So gold can only go up as far as I'm concerned. And so it's up today. The dollar now getting slammed on the lows. We're now almost at 138 again against the euro. The dollar index now down at 79.35. I think once it breaks through 79, it should be a quick move down to 78 on the dollar index. And this is across the board weakness in the dollar. It's down against all the currencies, down very strong against the Australian and New Zealand dollar. In fact, the New Zealand dollar is getting very close to an all-time record high against the U.S. dollar. Let me pull up a long-term chart so I see where it needs to go. Because the New Zealand dollar has held up better than the Aussie dollar during the dollar rally. So the highest the New Zealand dollar ever got was, it got to 88.5 about back in 2011. So now we're at 85 and change. So we only need about another 3-cent move up in the New Zealand dollar to hit a all-time record high. I think it'll do it before the end of the year. Now, the Australian dollar has a much longer way to go to recoup the highs. I mean, the Aussie dollar at one point got up to about $1.10 against the U.S. dollar back in 2011. So right now we're at 97 cents. So I don't know that the Aussie is going to make a new high before the end of the year. It could. It really could. But that might have to wait until 2014. But I do think that we can get the Aussie dollar up in the vicinity of the old highs, maybe up as high as $1.05 before the end of the year, maybe even somewhere between $1.05 and $1.10. Not sure if it'll be enough to break it. If the dollar really just rolls over, I mean, it's possible that it could be that quick, but I think maybe that's more of a 2014 event. I think the currency crisis will hit early in the Yellen term. But the real depth of it will take a little bit longer because she's going to fuel this fire, right? She's going to print more money as the dollar weakens. And as I said, she's not going to care about the immediate impact on prices because she's going to say that it's okay that inflation is getting worse because it's still very low. And since it was so low for so long, it can be above average for a while, and it'll just all even out in the wash because we really need to prioritize jobs, right? She's there to prioritize jobs in the economy as if she can actually create economic growth, prosperity, jobs by printing money. She can't. But that is what she thinks. And more important, that's not only what Janet Yellen thinks, that's what everybody thinks. Everybody is convinced that gasoline will put out the fire. Everybody. So that's what they're going to do. They're going to keep on pouring it on. And they're not going to understand why the fire gets bigger. They're not going to question why the fire has gotten bigger. All they're going to say is, well, we just need more gasoline on this fire, and that is going to put it out. But I think it'd be interesting if we could see a complete reversal in the stock market today, because maybe the stock market will get to worry about this bad news. That it's not necessarily bad news is good news. Maybe bad news is still bad. Even though it means more QE, it also proves that the QE that we already had didn't work. And a lot of the rally in the stock market has been based on the expectation of economic growth and higher earnings. It's not all about QE. QE is most of it, but part of the rally has been based on this false optimism about economic growth. So I do think it makes sense that we get another correction in the market on the realization that the economic growth isn't there. I don't think it gives us a stock market crash, but it certainly can give us a decent pullback in the stock market, and particularly to the NASDAQ, which the NASDAQ has had a bigger run based on the technology space, based on these high multiple speculative names that really got supercharged in the last few weeks based on a more QE and more money printing. So maybe we'll have a bigger pause there. But where I do think that the rally will be will intensify is in the mining space. These gold stocks have been clobbered based on the idea that the Fed was going to tighten. They're not going to do it. I've always known that, but the multitude on Wall Street, right? They're finally waking up to maybe the Fed's not going to taper in the next year, in the next 6 months. Of course, they're not going to taper ever, but so there is no taper, there is no economic growth, there is no recovery, right? So all those myths are being shattered. And as people realize how wrong they got it, how wrong people like Goldman Sachs were, yes, gold is a slam dunk sell. They couldn't have been more wrong. So I think you've got massive upside potential between now and the end of the year in the gold stocks. Not only in the gold itself, but in gold and silver mining stocks. I think that's where if people want to make money in the stock market right now, between now and the end of the year, That's where they're going to go. And, normally, we've had a lot of tax laws selling at year end. I don't know that we're even going to have that. I think all the tax laws selling is gone in these names. I mean, there's a lot of losses, but I think everybody who's going to sell is sold. So I think we're going to have a lot of buying. Maybe some people will take losses by covering their shorts. There might have to be some tax loss buying for some people who shorted gold and maybe want to cover some of their gains in other investments that they made earlier in the year. Because I think we got a lot of shorts that piled into the market in the last few months, or simply since June. 8554-SHIFT, that is our phone number. We got some open lines. We'll be right back.
To President Obama, Madam Pelosi, and all of the socialist econ professors across America, we're sorry. Peter Schiff is back on the air.
Yeah, I doubt the media is going to spend much attention on the dollar decline today, the 2-year low against the euro. Although, the rate at which the dollar is falling now, it's not, spectacular. I mean, the dollar's down, 0.75% today against the euro. It's down, that's about it against other currencies. So it's not getting it's not down 2 or 3 or 4%. It's not falling, as sharply as the yen was, at many days, earlier in the year when the yen was just getting obliterated based on the Abe comments and the Bank of Japan comments. But that's going to happen. I mean, that type of dollar carnage is going to come. And right now, that weak dollar isn't even impacting the oil price. Oil prices are down on the day. We're now at 98.44 a barrel for oil prices. And again, I think oil prices are reflecting the weakening in the economy. Now, I'm still bullish on oil prices, but it's possible that this oil correction could continue for a little bit longer. I don't think, oil's going to plunge, back down into the 80s. I mean, it could go into the low 90s. I mean, that is possible. We're at 98. I mean, maybe we can go down as low as 92. I wouldn't imagine that the correction would be any deeper than that, because I think the trend is going to continue. In fact, there might be a lot of support right around this 98 level. We'll have to see if, where the market holds, particularly if the dollar really gets weak. If the dollar gets very weak, it's going to be hard for the price of oil to have maybe get all the way down to 92, but it could, because there's a longer-term trend. But the trend is going to continue, and oil prices are headed a lot higher than $100 a barrel, especially if I'm right on the dollar crisis that is coming. Because that's the only thing that's going to stop us, right? I mean, the world's going to figure out we're not going to stop ourselves. We're not going to balance the budget. We're not going to cut entitlements. We're not going to cut government spending. We're not going to cut anything. In fact, we're going to increase government spending. We're going to increase QE. So what is going to stop us? Where is the discipline going to come from to force the United States to do the right thing? It's not going to come from the United States. It has to come from outside the United States, which means the method of our reform, right? The instrument that is used to rein us in is going to be in the foreign exchange market. This is the key. Understanding this is the key to everything. It's the key to investing. It's the key to understanding what you need to own and what you need to avoid. See, we didn't adopt austerity, but we're going to get it. Not because we want it, but because it's forced upon us by the rest of the world. I talked about an example on my own. You remember when I talked about going on a diet back on this show? I said I was about to go on a diet because I was just too heavy. And so I described it as my own form of personal austerity, because I was going to have to deny myself the things that I liked, eating. I was eating food that was making me fat. And so I was going to have to change my eating habits. which is what the United States has to do. We have to change our habits as a nation, as a society. We have to stop spending, and we have to start saving. We have to stop consuming and start producing. Right? That's what we need to do to get healthy. But that's not what we're doing. See, I was overweight. What did I need to do to lose that weight? I needed to change the behavior that made me fat. I couldn't do the government diet, right? What was the government diet? The government diet was to eat more junk food, right? The government diet is we need more stimulus so we can spend more. But the reason the economy was so sick is because we spent too much. So if I had been like a government economist and I had said, gee, I'm too fat. Why am I too fat? Or what do I need to do? I'm so fat. Well, I guess I need to eat more. I need to eat more of what I've been eating, and somehow that's going to make me lose weight. See, that's what the government wants us to believe. If we do more of what we did to destroy the economy, it's going to magically improve. But the reason the government didn't want a real diet, right, is the reason a lot of overweight Americans don't want a real diet. Because they want to eat the things that they enjoy. They don't want to change. Right? But that's what I did, because I actually wanted success. I wanted to lose weight. So what did I do? I changed my diet. And I dropped about 30 pounds in about 4 months. And now I'm not overweight anymore. Right? And, was it difficult? I mean, it really wasn't that hard. But yeah, I had to stop doing things. I liked eating pasta. I couldn't eat that anymore. I liked eating breads. You go to a restaurant and they give you all this bread before the meal. You got to sit there and not eat it, even though it looks really delicious and you want to have it. You want to put some butter on it and eat that bread. You got to deny yourself that. You got to say, I can't have that because I want to lose weight, so I can't eat that bread. But I stopped eating desserts, sugary things. I had to stop eating potatoes and a lot of dairy. Things that were making me fat, but that taste good. I couldn't eat them anymore. I mean, I had to really cut down. So what do I have to eat? I had to eat a lot of meat, which I was eating meat anyway, but I just eat more of it. I eat a lot of vegetables. I eat a lot of berries. Eat a lot of nuts and seeds, stuff like that. So I'm not going hungry. I just had to eat different things. I had to change my diet, and then lo and behold, the fat went away. But the austerity worked. If I had adopted a government diet, I'd have just been fatter. I was over 200 pounds. I got to over 200 pounds, and now I dropped to a little over 170. So now I'm back in where I should be. But that's what we need as a country. See, we need to go on an economic austerity. But everybody says, no, that's bad. Why is austerity bad? Well, because we have to stop doing the things that we like to do. Okay, but maybe the things that you like to do are destructive for you. If you like eating a bunch of junk food, does that mean you should keep eating it? Because maybe the reason you're not as healthy is because of that diet. So if the American economy is sick because we spend too much, we borrow too much, then we've got to stop doing that stuff. But nobody wants to do that. Nobody wants to be the bearer of the bad news that we can't keep doing that. And to kind of add insult to injury, instead of shrinking government, we come up with Obamacare. We come up with a gigantic new government entitlement government program when we're already broke and bankrupted from all the other government programs that we can't afford. And instead of scaling those back, that would have been like me on my diet deciding to now just eat twice as much food, to just start stuffing my face even more, and now I'd probably be 250 pounds. If I had gone on the government diet, I'd be close to a heart attack, which is what we're going to have. We're going to have economic cardiac arrest from all this stimulus when the dollar tanks. I mean, that dollar is like that little, needle that you watch in the hospital going up and down. I mean, the thing is going to go all over the place because we're going to have economic cardiac arrest when we have a dollar crisis, and all this bad behavior has to come to a halt. 855-4-SHIFT. We got a full board of calls. We'll come back to the phones after this.
We now return to the Peter Schiff Show. Call in now. 855-4-SHIFT. That's 855-472-4433. The Peter Schiff Show.
855-4-SHIFT. That is our number here at the Peter Schiff Show. We're going to go to the phones. John is calling in. He's in San Diego, California. Got a question about the bond market. John, you're up.
Yeah, hi, Peter. Thanks so much for the show. I'll get right to my question. You on okay there?
Yeah, I'm here.
Oh, I don't hear you. Oh, okay, great. Yeah, you've been rather consistent lately, well, even longer than lately, saying that the first major indicators of the crisis would be in the currency exchange markets in the dollar, rather than, say, the stock market or the bonds. And I'm always thinking that it's kind of the bonds, because for the simple fact that if I fear for the dollar, I don't want my dollars today, but I really don't want the dollars 10 years from now. So I'm thinking that we would see, the interest rates go up and the price of the bonds drop sooner than the currency change.
Yeah, well, you're missing one key point. I mean, you're right in your observation. If you don't like the dollar, then you got to hate the bond market. And owning bonds is worse than just owning your dollars today, because owning a bond is owning the promise for somebody to pay you dollars in the future. But the future value of the dollar is going to be much less than today's value, and the interest rate on those bonds is not nearly enough to compensate for that loss of purchasing power. So your observation is correct. It's the bond market that should go down first. But the reason it won't is because the Fed won't let it. Because as people make the rational decision to sell their bonds, the Fed comes in and buys those bonds to prevent the price from dropping and the yield from rising. But in order to do that, in order to buy the bonds that people have rationally decided that they no longer want, the Fed has to print dollars. And so now those new dollars are in circulation, and now the dollar goes down instead of the bond market. If the Fed didn't print more money, then you would be right. The bond market would go down first. But because the Fed won't let the bond market go down, it's sacrificing the dollar instead of the bond market. Now, what the Fed hopes is that the Bank of China, the Bank of Japan, foreign central banks will then buy those dollars to prevent the dollar from crashing. Because the Fed can't do anything about the dollar. The Fed can stop the bond market from crashing, but only if somebody else stops the dollar from crashing. Because the Fed is powerless to stop the dollar from crashing, so it needs help from everybody else. Now the question is, are the world's foreign central banks going to come to the aid of the Fed? They've been doing it in the past, but I can't see that they'll keep doing it. The Fed will never stop buying bonds because the Fed doesn't have to, and the consequences for the Fed of stopping buying bonds are short-term pain for the American consumer, the American government, so they won't stop. But if the Japanese and the Chinese and the Saudis and everybody else, if they actually stop buying dollars, that is good for their own economies. They might not understand that, but it is, because it means that they have more stuff. They can buy more stuff. Prices are lower for them. So I think that is what ultimately is going to happen. It's the dollar where you're going to see it first. In fact, we could have another rally in the bond market, but even if the bond market rallies, it doesn't help you if you're an investor in bonds. It only helps the speculators who are really highly leveraged in these bond markets, because even if bond prices go up by 5%, if the dollar goes down by 10% during that same time period, you're worse off. Because your bonds, even though they've appreciated, they buy less stuff. But if you levered up to buy those bonds, if you're a speculator, you're a hedge fund, and you've bought those bonds with massive leverage, then a 5% move up in the bond price maybe would give you a 50% gain on your portfolio. And so if prices were only up by 10% and you got 50% more, so it's the leverage that can make the bond investor money. But the dollar will be going down the whole time. Does that make sense?
Oh, yeah, that's great. That's really persuasive. I just couldn't get that. I think maybe 6 months ago I had a glimmer of what you were saying, but I forgot it because I somehow focused on something nearer term. But great explanation, yeah. Peter. Appreciate it. Thanks a lot.
And the bond market is rallying today on this weaker economic data, and the bond market might sell off a little bit more in the short run, or rally a little bit more. Interest rates might come down because so many people were expecting stronger data. Of course, we're never going to get stronger data. But what people don't understand is eventually it's the weak data that's going to crush the bond market, because it's the weak data that leads to more QE, that leads to more inflation, which is bad for bonds because it's bad for the dollar. So ultimately, it's all the weak data that's going to kill the bond market. People think it's going to be a strong economy that kills the bond market. It's going to be a weak economy. that kills the bond market. And in fact, even if it was a strong economy that killed the bond market, the minute the bond market was killed, the economy would cease to be strong. So that's not how it's going to work. It's going to be because the economy never recovers, that we have to keep printing more and more money. That's what's going to crush the bond market and then crush the economy even more. That's what's going to, the economy is going to be down, and then it's going to get kicked all over the place in the currency markets and the bond market. So, unfortunately, the future is bleak here. The crisis is coming. We've got Janet Yellen, there's no housing bubble, everything is great, completely blind and clueless, who's going to be at the helm, right? And it's like, Mr. Magoo there trying to drive through a busy street, expecting not to get into any accidents, although Mr. Magoo often doesn't get into accidents himself. It's just that everybody else around him gets into an accident, which is going to happen with the U.S. economy. But all these supposed geniuses who were so completely oblivious to all the problems of the past are even more clueless to the greater problems of the future that they have been busy creating. And again, that was Mr. Magoo. As Mr. Magoo drove around blind and oblivious, had no idea about all the accidents that were happening behind him. I mean, there were crashes all over the place, but somehow Mr. Magoo managed to get where he wanted to go, oblivious to all the damage that he left in his wake. And that is what's going on at the Fed. Let me go back to the phones. Douglas is calling in from Indianapolis, Indiana. Douglas, you're up.
Hi, I just wondered if you would make a statement. On November 1st, they are cutting food stamps for a family of four, $35. Will that be the camel that breaks the pen's back?
Well, are they actually doing that, or was that something they were going to do if we didn't, increase, if we didn't end the government shutdown, or is that going into effect?
It's something that was implemented that increased the amount of food stamps, and now it's being taken away. I mean, it's like having a homestead property tax exemption, and they take it away from you, but it was given to you from the first place.
Yeah, well, look, I mean, obviously it's going to make things more difficult for people who were living off of those food stamps, because the food stamps are really like money. Right? I mean, because, you can use them to buy stuff, so they really should be counted as part of the money supply, because that's really what they are. But to the extent that people don't have... Yeah, well, what happens? Well, they're just going to have to eat, they're going to go hungry, or they're going to eat cheaper stuff or whatever. But yeah, but of course, because the government isn't spending as much money, it does, that means that the government doesn't have to borrow as much money to finance the food stamps, so that would normally be a good thing, but government debt is going to keep on increasing for other things. So I don't necessarily think the economy is going to see a benefit from the fact that the government isn't borrowing money to pay food stamps, because it's still going to be borrowing that money. It's just going to be doing something else with it. But yeah, the people who aren't going to get as many food stamps as they were, or aren't going to have as much money loaded up onto their EBT cards, it's going to be more difficult for them because food prices are going up. And they're going to have less money.
When they get to the grocery line and they've got carts full of that extra $35 worth of food, do you think the same thing will happen that happened in Louisiana?
Which was, you're talking about when they just abandoned their carts?
Yeah.
Well, obviously, if they are spending more than they're going to have to reach into their pocket for the difference, or they're going to have to, put some of the food back on the shelves, or just not take it out of their cart and just leave with whatever their food stamps will provide. But look, this is what's going to happen. Americans are going to have to get used to getting by with less. Ultimately, it's not going to be because the food stamps are taken away. It's going to be because the price of the food increases so dramatically that the food stamps are inadequate to continue to buy. They'll be able to buy some things, but they're going to buy a lot less, because everything that they need to buy is going to cost a lot more as the Fed keeps printing money to prevent interest rates from rising. So, hey, thank you for the call. Yeah, go ahead.
Oh, I think this is like a test of what's going to happen when they begin withdrawing this from the people. All the entitlements. They want to just run a test, see how they react in the food stamp market.
Maybe, yeah, like a little small sampling. I mean, let's not necessarily a dress rehearsal because they're not really dressed, but let's have a small taste, trial balloon. Let's kind of see how people react to a small reduction in their benefits, because we know that much larger reductions are coming. Yeah, maybe, but it'll be interesting to see if anything does in fact happen, or will people riot? Will they get upset because the food stamps have been cut? And you never know. The cuts may never actually go into effect. It could be like the debt ceiling where Congress says if we don't act now, millions of families are going to see their food stamps cut. And maybe the government will come to the rescue in the 11th hour and save us from this and make sure that Thanksgiving comes, because it's in November, right? This is supposed to happen?
Yeah, November 1st.
Yeah, so I can see the congressman now. Yeah, but you can see the congressman, because it's going to be Thanksgiving. We can't take away Thanksgiving and Christmas dinner. This is the holidays. We can't be the Grinch that steals Christmas, and we can't rain on everybody's Thanksgiving. And so I can see how the politics would try to sell this crisis, and how we have to make sure that Americans aren't denied their Thanksgiving and their Christmas, because, it'll be so bad for the economy and the consumer psyche, and consumer spending will suffer if people have to take money that they would have spent on presents and now spend it on food. What are we going to do? We have this, bah humbug Christmas. So we might not actually have this experiment, because the government might come in and undo that at the last minute. Hey, we got a break. We got one final segment coming up. Stick around. We'll be right back.
Last on the air, the national debt added another $7.89 million. Luckily, Peter's intelligence is growing twice as fast.
That's incredible.
Welcome back to your source of sanity in an insane world. It's the Peter Schiff Show.
We had another economic data point that came out earlier this morning, which I never really touched on, and that was U.S. construction spending, which rose to a 4.5-year high. This is for the month of August. Now, of course, Wall Street will interpret that as being good news, bullish. The home builders, which all got clobbered yesterday, are rallying today, although they're not recouping what they lost yesterday. But that's part of the good news. But again, I think this construction spending, and some of it is government spending, on infrastructure projects. But there's also private sector construction. But I think a lot of it has to do with the false sense of optimism. The builders are believing the hype about a U.S. recovery, and so they want to construct so they can sell property into this recovery. They're believing that the housing recovery is genuine, that demand for houses will continue to increase, that the price of houses will increase, and so they want to construct them. But this is all misplaced optimism, and ultimately this new construction spending will not only come to a halt at some point in the future when the builders realize that they are mistaken in building and the market is not going to be as good as they think, but because they overbuilt in anticipation of a recovery that doesn't exist, the extra building will simply add to the glut of unsold inventory coming onto the market. So instead of the builders correctly anticipating a weaker housing market and cutting back on their building now, they have made the mistake of forecasting a stronger market And now they're going to exacerbate the weakness of the market that they can't see because they're building houses that they shouldn't be building. So all this is bad news. I mean, Wall Street can celebrate it as good news because they don't appreciate what's actually going on, because they too believe in this false narrative of recovery both in the housing market and the economy, and they see this higher construction spending as validating their beliefs. Instead, for me, it just reinforces to me how wrong everybody is. So it kind of even validates my perspective as well. Jeffrey is calling in. He's in Spokane, Washington. Jeffrey, you're up.
Yeah, I was wondering, I noticed that most of my friends are awake about the Federal Reserve, but my parents and people like that kind of don't have a clue. But most people don't know what to do about it. Do you ever see it being abolished?
Well, I think it's going to take a lot to abolish it. I think that the first thing that we need to do is diminish its power, rein it in. But, I mean, right now, I think so many people still have confidence in the Fed. And so the confidence is going to have to be lost. So I think before we can make any progress on diminishing the Fed's role, maybe eliminating it, who knows, but we're going to have a currency crisis. It's going to have to be obvious to everybody that the Fed botched it up. And so when the dollar crashes and we have runaway inflation, hopefully by then people will realize that, the Fed got it totally wrong. Right? The Fed printed all this money and got us into this mess. Now, are they going to pretend, well, there's no way the Fed could have known this? I mean, nobody could have possibly predicted this. Nobody could have seen all this inflation coming. Oh, it's impossible. And then, what about Peter Schiff? Oh, well, he's been saying this for years. I mean, he's just a stop clock. I mean, he's been crying inflation for years, and there wasn't any. All of a sudden, it came up on us, just out of the blue, out of nowhere. Like a meteor just struck. And so, that's why. As if the inflation all of a sudden came there out of nowhere. No, it was building and building in the system all the years that I was warning about it. It was there. The government was hiding it. The government was denying it. But yes, eventually there'll be so much inflation. There'll be an avalanche of inflation, a tidal wave of inflation, that it'll be impossible to deny it anymore. But they're going to pretend rather that there was no inflation at all, and all of a sudden it just happened, and nobody could have possibly predicted. And they'll say, well, it happened because of the dollar crisis, and nobody could have predicted that the dollar would plunge like this. Well, yeah, I mean, anybody who understood would have predicted it, but but maybe they won't get away with it by saying nobody could have seen this coming. The Fed they're geniuses. They're the smartest people, and if they couldn't figure it out, nobody could. Hopefully, the Fed will be totally discredited, and then we'll be able to make some meaningful progress. But of course, we also have to discredit Congress. We got to clean house, literally. We got to get new people in there that understand the role of the Fed and Congress in destroying the country, so they know what needs to be done to resurrect it. Last caller is Andy. He's calling from Southern Miss. Andrew, you're up. Andy, you're up.
Hey, Peter, how you doing? Listen, I'm happy I got on. There's an article that relates pretty well to something you were talking about before, about the analogy between losing weight and the government putting things off. So this is 2011, August, a whole flurry of articles. This one's the Los Angeles Times. Michelle Obama endorses Olive Garden Red Lobster menu changes. First Lady Michelle Obama gave her support Thursday to helpful menu changes at Darden restaurants, parent company of mega chains such as Olive Garden and Red Lobster. Okay, so Michelle actually gives a big press conference. I'm here today because this is a big deal, Obama said. I'm here because this is a breakthrough moment in restaurant history. All right, so the punchline is that the goal is going to be to cut the fat and calories by 20% over a 10-year period. Okay, so I'm sure you'll see the irony in that. But looking a little bit further, the guy that owns Darden, the CEO, is named Clarence Otis. He was named like the most powerful guy in Florida. I don't know. I just thought you'd enjoy the sort of irony.
Yeah, well, it is a little bit of irony that she wants to cut the fat out of restaurant meals, but not out of government. And of course, we have to cut more than the fat. We have to cut the bone and the meat and the bone of government, because we don't need this government. As far as I'm concerned, it's actually all fat. But we need to cut a lot of what politicians regard as being the most essential part of government, because we can't afford it, and it's undermining our economy. Hey, gold now up $27. We're up $60 an ounce now since the debt ceiling was raised. So much for the Goldman Sachs slam dunk call. Is anybody going to come out in the media and basically say, gee, Goldman really botched this up? How could they have been so wrong? No, they'll just forget about that. Hey, you've been listening to the Peter Schiff Show here at SchiffRadio.com, the gold standard in talk radio. Bye for now.